It's fact-based because we had a drawdown of more than 20% and then we made a new high. So like the weird math that like let's say a commodity trading advisor, a CTA
right,
has is that when you have a drawdown and then you make a new high, that date is the start of a bull market.
Huh.
So actually, like in the mind of the institution now, breaking 61.41 was a new bull market.
Wow.
But the retail investor bought it at 4,800 to 61.41. But the algos are going to say a new bull market started like last week. MicroStrategy has 600,000 Bitcoin.
Yep.
If the U.S. government wants to get to 1 million Bitcoin, or Qatar, or UAE, or I don't know, UK, okay, and they say I'm going to buy 1 million Bitcoin in the open market, the UK buying 1 million Bitcoin, or the U.S. buying, or China, Bitcoin's going $1 million.
Tom Lee begins with a reality check. Institutional investors are often forced sellers during volatility. Bound by risk management protocols, they must cut exposure when the VIX spikes or when markets draw down. This reactive behavior often traps them in a cycle of selling low and missing rebounds. He points to historical data. As long as there's no recession impulse, major market sell-offs typically result in V-shaped recoveries.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Like we called it bananas, like numbers that were just bananas, right?
Yes.
Well, there's a couple of things. Institutional investors, they have to sit in guardrails. And like when the VIX goes up, they have to cut risk. And when the market has a drawdown, they have to cut risk. So basically, when the market falls and there's volatility, institutions can't hold on to much. So they're forced to sell. And so we would show them, the reason we said there's waterfall declines are V-shaped is that if you look at the last 100 years, as long as you don't generate a recession impulse, it's always V-shaped.
Right.
So that was our bet. It's like, this is a growth scare because high yield wasn't reacting, so it was just the stock market reacting.
Right.
Now, a second thing that got people super bared up, our institutions, was, Tom, the Fed's not coming to the rescue. They said, the only reason markets rally is the Fed cuts rates and unleashes money. And actually, our argument was, that's actually an illusion. So our belief was that you'd still get V-shaped even if the Fed didn't cut. But a lot of people were saying, look, the Fed said they're not going to cut.
Right.
So we're going to actually keep falling.
Right.
But instead we had the V-shaped. When the Fed is adding liquidity, it's just giving the money to the banks.
Right.
So if the banks aren't lending, like that was happening like after 2008. They gave the money, the banks just built up reserves.
Right.
Like it wasn't sloshing around.
Correct.
So the more important money is actually retail. And that's... And that's, there's 4 cohorts, 4 or 5 real distinct cohorts in the market today. So we know there's institutional.
Right.
There's non-U.S.
Yep.
Right. And
Foreign.
everyone's like, oh, we're leaving the U.S. There is high net worth.
Family offices.
Yeah, exactly. They stay bearish because they follow what hedge funds do.
Right.
Then there's corporates who do buybacks.
Correct.
And then there's retail. Retail was the only one buying the market at the April lows.
40 billion in March and April.
Yeah. I'm very proud of the retail investor. I think it's because retail investors see this as a stock market. They're like, I like Palantir. I own Meta. Like, should Meta get killed because of tariffs? You know what I mean? Like, should Palantir get down to 80? Like, if you think about it, like, a retail investor sees it as stocks.
Right.
But the higher up you go, they're more macro. They're like, oh, Trump's going to just drive us off a cliff. The Fed's going to kill us. And so these actually create biases.
Right.
And then when the actual economy doesn't, or the stock market doesn't react to what their framework is, then they're like, oh, the market's insane. This is the dumbest rally.
Correct.
Only retail's buying. And so then they're caught off sides because they're now sitting on cash, institutions, on a complete full V-shaped recovery. And that's why it's the most hated V-shaped recovery. It's fact-based because we had a drawdown of more than 20% and then we made a new high. So like the weird math that like, let's say a commodity trading advisor, a CTA,
right,
has is that when you have a drawdown and then you make a new high, that date is the start of a bull market.
Huh.
So actually, like in the mind of the institution now, breaking 61.41 was a new bull market.
Wow.
But the retail investor bought it at 4,800 to 61.41. But the algos are going to say a new bull market started like last week. You know, crypto is a narrative-driven space, okay? Because it really runs on trust.
Right.
And so we know Bitcoin, the thesis is trust and, digital gold. But I think the story now is programmable money. And so maybe what you're seeing is people are discovering that you not only want programmable money, but you want to be running on the biggest network that does programmable money. And Ethereum is 300 billion. So it is the largest smart contract blockchain. So
right.
I think that's why Ethereum has the opportunity to really transform. Yeah. MicroStrategy has 600,000 Bitcoin.
Yep.
If the U.S. government wants to get to 1 million Bitcoin, or Qatar, or UAE, or I don't know, UK, okay, and they say I'm going to buy 1 million Bitcoin in the open market, the UK buying 1 million Bitcoin, or the U.S. buying, or China, Bitcoin's going to $1 million, right? Whereas someone says I can buy like the U.S. government might say MicroStrategy has 600,000 of this already.
Yeah,
I'll pay 200% premium, and it was cheaper than paying $1 million per Bitcoin. So that's called a sovereign put.
Right.
Well, guess what? In the Ethereum world, because it's a staked token, if one of these treasury asset companies gets to 5% of ETH, they are hugely important to the ETH ecosystem.
100%. Yeah.
So then their multiple should go up. Because, Goldman Sachs, for instance, if they do a Goldman dollar and it runs on Ethereum, they want to make sure the Ethereum network is secured. So eventually they're going to be buying a lot of Ethereum.
Right.
But then the staked entity already has it. So maybe they'll just buy the staked entity.
Right.
So the staked entity has a Wall Street put.
Tom Lee doesn't pull punches when it comes to politics on Wall Street. He reveals a surprising stat. 65% of fund managers voted for Biden, while the bond market historically leans Republican. This political bias, he argues, colors how institutions view market risk, especially under Trump, who many in finance view as unpredictable or reckless. Lee says this created a psychological wall. Even when data suggested no recession, many couldn't bring themselves to stay invested because of TDS, Trump derangement syndrome.
I like Ethereum because it's a programmable smart contract blockchain.
Right.
Okay. But that's a mouthful.
Yeah.
I would say the real reason I kind of would say I backed into Ethereum is that stablecoins are really taking off.
Circle.
Yep.
$70 billion company.
Circle's like the best IPO in 5 years.
Correct.
And it trades at 100 times EBITDA. And it has made the performance. For some funds, it has made their year.
Wow.
It's what put people in the top 1%. So proof in the traditional Wall Street world, Circle is like God level stock.
Right.
And it's a stable coin. Stable coins are the ChatGPT of crypto because it's really crossed over into the mainstream. But it's really evidence that Wall Street is trying to equitize tokens.
Correct.
But then the crypto world is tokenizing equities because they tokenized $1, right? And then now you're seeing, JP Morgan wants their own stablecoin, Amazon, Walmart, Goldman. Well, stablecoins are a great business model and they work really well for consumers and merchants, but they all have to operate on a blockchain.
Correct.
And the majority of stablecoin transactions take place on Ethereum. So Ethereum's been like kind of out of favor. It peaked at close to 5,000 several years ago, and it was stuck at like 1,400, 1,500. It's back to like 2,400. But Stablecoins are only 250 billion today.
Correct.
It's 30% of the gas fees on Ethereum. And Ethereum mints more than 50% of all stablecoin creations. Treasury Secretary Scott
He loves them.
Yep. And he says he thinks it's a $2 trillion market, which is 10x increase. The U.S. government wants more stablecoins because stablecoins collectively are the 12th largest holder of treasuries.
Correct.
And they're creating a lot of dollarization. 80% of stablecoin usage is outside the U.S.
Right.
So, but a 10 times increase in stablecoin creations is an exponential growth in gas fees for Ethereum. So I think Ethereum is a very direct beneficiary of Wall Street trying to equitize crypto.
Correct.
And crypto tokenizing equity. It literally sits in the middle. And so I think that's why Ethereum, I think, is going to be rediscovered this year. And then, of course, we're seeing it now because Robinhood is, compared to 2023 and 2020, the institutional universe is even more bearish.
Wow.
They're convinced we're late cycle. One thing to keep in mind is if you look at political affiliation, in the equity market, 65% of fund managers voted for Biden.
I did not know that.
Yeah. So, but if you look at the bond market, it flips. The
Right.
bond market historically votes Republican.
Correct.
So, most people think Trump is a madman, right? Because they didn't vote for him.
Are
So-
you saying TDS is one of the reasons why people did not buy the dip?
Yeah, we write about it a lot in our research, actually. So it's a partisan stock market. And actually, people... So these have been uncomfortable conversations that we've had all year
I would
because...
imagine. No.
Yeah, because they're like, Tom, we can't... You're telling us not to sell. Because our advice was, don't sell. Like, even though I didn't know where the bottom was, I did know it was V-shaped.
Right.
But they're like, Tom, we can't do that, And then I was like, well, I showed the stat. Whenever the VIX is above 60 and then it closes below 30, 100% of the time it's been the bottom.
Correct.
And they're like, well, it's different because the Fed's not going to save you. So everyone found a reason to actually argue for why a recession was starting. And as you know, economists went full on recession call.
That's correct.
So if you're a equity guy, how can you go stocks are going to do V-shaped when the economist of the firm just said there's a recession? So
Right.
I think they got caught, and we're not having happy conversations with people.
At the core of Tom Lee's thesis is this: retail investors have emerged as the true smart money. While institutions obsessed over rate cuts and political risks, retail traders were busy buying what they believed in. Not ETFs, not macro bets. Stocks. This bottom-up conviction allowed them to act faster and more decisively, buying names like Meta and Palantir during the drawdown, while fund managers stayed frozen by models that didn't match reality.